Here's a detailed summary of the PulteGroup Incorporated, PHM, Q1 2026 earnings call transcript, suitable for reading aloud. PulteGroup Incorporated Q1 2026 earnings call summary. Good morning, everyone. Today, we'll be reviewing PulteGroup, Inc.'s operating and financial results for the first quarter ended March 31, 2026. Key financial metrics. PulteGroup delivered strong performance in the first quarter of 2026, navigating an increasingly complex operating environment. Revenue. Home sale revenues reached $3.3 billion. Profitability. Earnings per share were $1.79. Gross margin. The company achieved a gross margin of 24.4%. This represents a decrease from 27.5% in Q1 2025, primarily due to elevated incentives, which stood at 10.9% of the gross sales price, an increase of 290 basis points year-over-year. Land investment. PulteGroup invested $1.3 billion in land acquisition and development. Shareholder returns. A significant $360 million was returned to shareholders through share repurchases and dividends. Financial strength. Following these allocations, the company ended the quarter with $1.8 billion in cash and a net debt-to-capital ratio of effectively zero. CEO's key statements. Ryan Marshall, President and CEO Ryan Marshall opened by commending his team for delivering exceptional results in a quarter impacted by domestic and global events. He emphasized the company's discipline and proven business platform as key drivers. Build-to-order shift. A significant strategic highlight is the company's progress in shifting back towards a build-to-order model. In Q1 2026, build-to-order homes accounted for 43% of net new orders, up from 40% in the prior year. This is the first step in their plan to reach a historic mix of 60% build-to-order and 40% spec. Spec inventory management. PulteGroup made considerable progress in lowering spec inventory, particularly finished specs. They ended the quarter with an average of 1.4 finished specs per community, well within their target range of 1 to 1.5. This level allows them to serve quick move-in buyers while supporting the build-to-order strategy. Demand environment. The spring selling season developed typically, with orders increasing sequentially. Despite higher rates and costs, consumer engagement in home buying remained strong, with over 8,000 homes sold in the quarter. The company is benefiting from demand in the move-up and active adult segments, where option and lot premiums average over $100,000 per home. Affordability challenges. First-time buyers continue to face affordability challenges and job security concerns. PulteGroup is employing incentives, including low fixed-rate mortgages, to address this, though this comes at a cost, as evidenced by the 10.9% incentive load. Discipline starts. The company demonstrated discipline by starting approximately 6,500 homes against orders of 8,000 homes, helping to clear excess inventory and allowing for stronger sales from a position of strength. Long-term optimism. Ryan Marshall expressed optimism about long-term housing demand and confidence in the company's business model, highlighting three key strengths. 1. A substantial land pipeline of approximately 230,000 lots, including 35,000 owned and finished lots. 2. A strong market presence across major markets and the ability to serve all buyer groups, benefiting from the more affluent Pulte and Del Webb buyer segments, while maintaining a presence with the Centex brand for first-time buyers. 3. A culture committed to superior build quality and customer experience, contributing to their ranking as one of the Fortune 100 best companies to work for. CFO's key statements. Jim Osowski, Executive Vice President, and CFO Jim Osowski provided detailed financial and operational insights. Net new orders. Net new orders increased 3% year-over-year to 8,034 homes, valued at $4.6 billion. This growth was driven by a 9% increase in average community count, though absorption paces decreased by 5%. Florida strength. Florida operations were a significant driver, with orders up 18% statewide. This reflects improving inventories, strong land positions, and expert leadership. Buyer mix. Orders. Q1 orders comprised 38% first-time, 39% move-up, and 23% active adult buyers. Closings. Q1 closings consisted of 38% first-time, 39% move-up, and 23% active adult buyers. Closings and ASP. Home sale revenues were impacted by a 7% decrease in closings to 6,102 homes and a 5% decrease in average sales price, ASP, to $542,000. ASP decreased mid-single digits across all buyer groups, reflecting competitive conditions and elevated incentives. Backlog. At the end of Q1, the backlog stood at 10,427 homes with a value of $6.5 billion. Spec inventory details. Of the 14,090 homes in production, 6,349 were spec homes, representing 45% of homes under construction. Finished spec homes decreased by nearly 500, 24%, in the past 90 days, reaching 1,515 units. Forecasting. Q2 2026 closings, expected to be between 6,700 and 7,100 homes. Full year 2026 closings, reaffirmed guidance of 28,500 to 29,000 homes. Community count growth, expected to be 3% to 5% year-over-year for the remainder of 2026. Q2 2026 ASP, projected to be between $540,000 and $550,000. Full year 2026 ASP, reaffirmed guidance of $550,000 to $560,000, anticipating a higher mix of build-to-order closings. Q2 2026 gross margin, expected to be the low point for the year, in the range of 24.1% to 24.4%. Full year 2026 gross margin, maintained guidance of 24.5% to 25%, likely towards the lower end. Margins are expected to recover in the second half due to increased closings of higher-margin active adult and build-to-order homes. SG&A expense, full-year guidance maintained at 9.5% to 9.7% of home sale revenues. Financial services, reported $13 million in pre-tax income, down from $36 million in Q1 2025, impacted by lower volumes, reduced capture rates, and lower net gains from mortgage sales. Mortgage capture rate was 85%. Land banking, approximately 18,000 lots, or 8% of controlled lots, are with land bankers. The vast majority of controlled lots are under option with underlying land sellers, emphasizing risk transfer and mitigation. Deposits for land banking partners are typically around 15%, with interest rates in the low double-digit range. Cash flow guidance. Projected cash flow generation for 2026 is approximately $1 billion, influenced by anticipated land acquisition and development spend and an increase in build-to-order homes. Significant risk factors. Economic uncertainty. Domestic and global events continue to impact consumer lives and the economic environment. Interest rates and costs. Higher interest rates and general costs pose challenges to affordability. Geopolitical events. Ongoing global tensions create uncertainty and can influence market dynamics. Competitive market conditions. Elevated incentives are necessary in many markets to drive sales. Land impairments. Approximately $6 million, 20 basis points, was recorded in Q1 related to land impairments in 2 communities, reflecting competitive market dynamics and efforts to clear excess spec inventory. Highlights: strong operational and financial results despite a challenging environment. Significant progress in increasing the build-to-order mix. Effective reduction of finished spec inventory. Robust demand in move-up and active adult segments. Exceptional performance in Florida. Strong land pipeline and financial position with effectively zero net debt. Increased Net Promoter Score to 65, placing PulteGroup among top service leaders. Recognition as a Fortune 100 Best Company to Work for the 6th consecutive year. Lowlights: year-over-year decline in gross margin due to increased incentives. Elevated incentive load, 10.9% of gross sales price, to address affordability for first-time buyers and clear spec inventory. Slower demand in West and Texas markets, though showing signs of stabilization. Lower pre-tax income from financial services operations. Management's forecasts for future quarters. Q2 2026 expects 6,700 to 7,100 closings and gross margins in the range of 24.1% to 24.4%. Anticipated low point for the year. Full year 2026. Reaffirmed guidance for closings, 28,500 to 29,000, ASP, $550,000 to $560,000, and gross margin, 24.5% to 25%. Community count growth is projected at 3% to 5%. Projected land acquisition and development spend of $5.4 billion. Most important statements. Ryan Marshall, CO. In a quarter that grew increasingly more complicated, you delivered exceptional results both operationally and financially. He also emphasized the strategic shift. This quarter was just the first step in a process that will take several quarters to complete, but I am encouraged by such early success. Regarding future demand, he noted, if things can get resolved and rates were to come down a little bit, I think things could get even a little bit better. Jim Osowski, CFO. Q1 house costs were down 5% from the first quarter of last year to $75 per square foot. Savings were led by lower lumber costs, but we have also achieved savings across a wide array of building products and services. He also provided clarity on future margins. We expect Q2 gross margins to be the low point for 2026. We are forecasting gross margins to recover in the back half of the year as we benefit from increased closings of higher margin active adult and build-to-order homes. In conclusion, PulteGroup demonstrated resilience and strategic execution in Q1 2026, managing challenging market conditions effectively while positioning for future growth and continued shareholder value creation.